All right. Very good afternoon to all of you who have joined us today. Uh, Thanks for this special session with our partners, Mojo Domo. We've been doing monthly sessions with them where curated startups get to pitch to some of the top investors in the network. A little bit about Thai Bangalore. We are so we're a network run by entrepreneurs, of the entrepreneurs, for the entrepreneurs. We have a 20,000 entrepreneurial community. Our aim is to accelerate the growth of entrepreneurs through our partners and through the ecosystem. It's done through charter members and other members. We work with partners like Mojodomo, Investor Connects, Pitch Days, all of that. What I also wanted to share today was about our annual flagship conference called Matrix 2022. It's done by the very popular Matrix Forum, a think tank started by Thai back in 2014. During this session, we are running quite a few things apart from startup awards and insights that are going to be shared around digital next, future tech, all of that. We, in fact, this is a learning and development session where we come across the latest trends, business opportunities, and growth efforts, and some real life use cases among startups. What we're also doing is with our partners, Mojo Domo, we're also facilitating one-to-one meetings with investors, with corporate partners, and various other people. So we will send you this communication right after this session. I'd like to take the opportunity to also introduce you to the Mojo Domo founder, Hormaz. He will be introducing the panelists. Over to you, Hormaz.
Hey, thanks, Vinay. A very warm welcome and good afternoon. I am Hormaz Charna, founder and CEO of Mojo Domo. Welcome to all of you to yet another session of Mojo Domo, Mighty Startup Hub and Thai Bangalore's webinar series. After running 3 successful startup showcases, this time we thought let's put the lens on the other side of the coin, that is from an investor's perspective, especially that of an angel. So with the startup ecosystem becoming more and more vibrant day by day, large number of people in India as well as NRIs are getting intrigued. However, we felt there is a lack of clarity on their part regarding how to go about investing in startups, analyzing them, understanding the risks, regulations, exits. So we thought this time let's take up this critical topic and simplify it for the audience. Equal the same, we have a very experienced panel to help us navigate through the nuances of angel investing. So we have the privilege of Mrs. Sharda Balaji, who is the founder of Novo Juris and an active angel. Mr. Praveen Sinha, who is the managing director of PinCap and the ex-co-founder and MD of Jabong, and he's also an active angel himself. And we have Ravindra Krishnappa, who is the managing partner of July Ventures. Thank you all of you for joining us and a warm welcome. I'll request all of you to give a quick introduction. So, Sharda, Praveen, and Ravindra, if you could, please. Sharda, you're on mute.
Thank you so much, Hormaz, Mojo Domo, Thai, for having me over. My name is Sharda. I have been running Novo Juris the last 14 years, a law firm focused on early stage investors through the and startups in tech-enabled space through the continuum of them thinking through their journey itself to setting them up to fundraisers, multiple rounds through the continuum of seed to ABCDEF, and them in their growth phase. Either they acquire companies for their inorganic growth, or they get acquired themselves. So that is what we do, apart from many other things, of course. And I'm also an angel investor, directly investing into companies, and also invested into a couple of funds, sit on a few boards as an independent director.
Lovely. Good to have you, Sharda.
Thank you.
Praveen?
So currently, I'll just introduce what I'm doing currently. I run a fintech venture and a small hedge fund, which is into quantitative trading. On the PinCap side, it's an NBFC, which does fintech partnership along with personal and business loan. I have been part of investment committee as well, including some of the government led investment in startup, which includes IOCL, GAIL. So I'm part of that investment committee as well. I do equity funding as an angel and also do a portfolio funding through certain ventures. My space is generally not fixed. It's more on the founders and the solutions that they are trying to solve for. Some of my investment had an exit. The last one which I did was into drone space. And before that, one company got acquired by Amazon and another one got acquired by Quicker. So certain good success and some stable and certain heavy losses, but overall a profitable initiative for me. Thank you.
Thank you for coming out honestly. Yeah, Ravindra, over to you.
Yeah, thanks, Thomas and Mergedomo and Tai. I guess my background has been an entrepreneur and an investor in multiple flip-flops. So for the last, I guess I started my first angel investment in 2003 when we set up an incubation center, and we were running an operation that became that was a precursor to Axel. So Prashant Subrato and I started. That was my first exposure to angel investment. So in some ways, I've been doing this for 2 decades now. But I went back to being an entrepreneur till 2010. 2010 to 2015, I was a very active angel investor. Had about 20 odd investments, either individually or with Indian Angel Network. I still, out of those 20 odd investments, I still have about 6 or 7 that are active. The rest are either good exits or somewhere in between. A few failures that Praveen talked about. And the last 2 years, we actually started July Ventures, which is into early stage funding, especially on B2B and what we call as the new emerging stack that we are trying to build out. So including fintech, etc. We are active angels. I've always been an active angel, which means that I get involved right down to carrying the card and going and meeting end customers, working through. That's the way I operate. And we continue to operate in that mode. So if what you typically would have heard us operational VCs, we have been doing that for a while now. And happy to answer any question that transitions all the way from angel to incubation to Series A, B, and beyond Series B, I will hand over to Sharda because she went all the way to F, and I've not funded anything beyond Series B. But yeah, I'm still involved in a few which are in Series F. Hopefully, that will give me the unicorn exit. But yeah, I do have currently two companies in my portfolio that are unicorns.
Sure. So yeah, good. Thank you for that extensive introduction. So, keeping time into consideration, this is a 1 hour session. So we've lined up around 8-10 questions, which I will bounce off to any one of you. But I would request if any one of you has, want to add to it, please feel free to do so. So we can have an open conversation. So let me start off by the very basic question of what is angel investing and how to be classified as an angel investor. So, Sharda, if you want to, take it up first.
Sure. I don't think there is something called a classification of an angel investor. As an individual, when you are giving that first check to some of the smaller of the companies, we kind of call them angels in the true sense of the angels. Because of the early investment, but maybe these are the first check that the company would receive, and therefore an angel investor is somebody who kind of gets the pulse of the founder himself, and invests in his idea, in his zest, in his passion, and take it forward. And many a time it can be an active angel like Ravi mentioned, or it can be someone who understands that space and adds value. So for an early entrepreneur, it can be multiple areas that he really needs help on, next fundraise to hiring to customer contacts to just setting himself up to many of those nuts and bolts. And that's what an angel investor typically helps in early stage.
Sure.
So there is a technical set in the sense that SEBI defines as somebody who is able to invest a certain amount and set aside a certain portfolio.
Okay.
In the US, we have the equivalent of an accredited investor. So the US, it's 100K. So anybody if you have any NRIs or anybody outside who's listening to this, then the US has 100K.
In what does SEBI define it as?
SEBI has not put a number to it, but it is typically around 25 lakhs is what you should put
And
out.
that too, I think it's to be invested over a period of 5 years.
Over a period of,
That's into the angel fund, but
Right.
otherwise, if it's not into a fund and you just want to give a check to the company, there is no such.
There's no such.
Right. Correct. Fair enough.
So the only piece I think is I believe, and this is something for the angel investors, that you need to figure out why they want to invest, right? Is it because they want access to early deals? Is it because they think they can help in that particular area? So it's very important to figure out why is it that you want to be a player in this space.
Right. So is it just for financial gains, or do you think we can add value in, as Shada rightly mentioned? Sure.
Both are fine as long as you're, internally you internalize what is it that you want out of it, right? Both are fine.
And also, is there any technical difference for the audience benefit between a seed investor and an angel investor? Or both are?
Do you want to take that? I think so. I said, I think it's the disposition. A seed is mostly a syndication. An angel is an angel who says, "I believe in you," the individual. Right? And that's my definition. I don't know if you want to.
I'll just add to it. And generally what happens is that when the idea is getting germinated, so it's the phase of the startup. So seed funding, so angel investors can come during seed funding as well. But generally the way it happens is that the angel comes during POC. So it's pre-revenue probably. And that's why these three numbers gets mixed up. Amount of funding, ticket size gets smaller, and the phase in which the startup is. So risk appetite is the highest because the product or the idea has not been tested. So it's the cut that the investors will take. I generally don't try to differentiate whether it is a seed funding or an angel funding, but the ticket size ensures that at what process you will be able to, or at what phase you will be able to enter. Because once it's post revenue and high growth, the valuation goes so up that a small ticket will not be interested in raising those smaller rounds. So the best points to enter those seed investors or angel investors are during the initial phase before the idea has been tested.
Sure. So also wanted to discuss and bring out what are the risks that an angel should look at. So what kind of risks would be there and what kind of mitigation process would be there? Ravindra, I'll start with you on this.
So the risks, all investors kind of carry three risks, right? It's first and foremost, it's the people risk, right? Which we, as angels, I think that's the highest on the list. And Ravin talked about, his first focus is on the people and will they be able to take it forward. So I call it as the people risk, the market risk, and the product / positioning risk, right? Those are the three things that you have. The tendency is for a lot of people to worry about the product or the market risk. But as angels, in some cases, the product market fit has not yet been achieved. So you are essentially taking a people risk in most other cases that they will be able to navigate. But having said that, India in some ways is very special because, if I take a very thin slice and say that this is meant for only a certain set of people. In India, the market becomes so large when you add those numbers, right? On an Excel, it seems to appear that everything has a market in India, right? So in that sense, I would say top three is the people risk. Top first is the people risk and the ability of the team. And in some cases, I think the only distinction I will make is that at this stage, there could be a team, there could be an individual, there could be just 2-3 people coming in. You have to evaluate whether that team can scale and work. Because as an angel, you are coming in very early, and your exit hopefully will happen before Series B, right? Because that's the time you will be diluted out. It's a secondary buy at a Series A or a Series B. So as angels, it's the first risk that everybody talks about is a people risk. I would add one more point, which is the time risk, right? Because you have to allow for a slightly longer period of illiquid investment for you to be able to exit, right? And then
Ravindra, if I just take a leaf out of your point of people risk, how does an angel analyze that by is this team the right team? Again, because that's a logical next question, that how would any of you as angels look at that? One is the educational background or a pedigree. What cuts through all that?
I can talk, I'm sure each one of us have our own checkpoints to work through. For me, it is sincerity in intent, effort, and their ability to actually have done a deep level of thinking into that space, right? I hate it when somebody comes in and throws me some shallow numbers and says somebody has done this, so I will do 40% of that market, and because I've got this great idea, because I'm going to be the Uber of XYZ, right? Where they have not done the deep level thinking to be able to go back and say, look, have you really spent time understanding that market and walking your talk, right? To me, that's the first. It's almost like the first check. If you don't pass that, I don't even go to the next level.
Sure. Perfect. Sharda, any special checkpoint for you?
So just going back to what Ravi was mentioning about the risk itself, right? For an angel, it is, you do not want to be on the head of the waterfall, right? You would want someone else to invest into that company and help that company scale up further. So is there a way? One of the other things that we also check is that person's ability to scale. At a point in time, like Ravi mentioned beautifully, that have you done something like this and have you gone deeper? But you'll also think of, do you have the ability to do what you're saying you're going to do? And if you can wait out a month or two for at least testing whatever they said and whether they are doing or not, would be a great one. That's one of the small tests that I do. The other is, as lawyers, right? When they come to us, they kind of discuss a lot more things than they would otherwise discuss with an angel investor. So that's another advantage sometimes I do get.
And you advantage.
No, they share it knowingly. So the other is, there is that much the check size that we give that moves the needle. So is there a way? One of the other risks that I say is, instead of you just investing, and we are going to talk about it in a bit, is can we make that a larger check and many more people investing? And therefore you bring in that other knowledge of evaluating the company and the founders itself. So, but at an early stage, of course, it is about the founder and the market that they might be operating in and how large is that market.
Sure. Thanks. Praveen, anything from your side? Any other personal checkpoints?
I think broadly, Sardaji and Raviji has already captured.
Sure.
And one key aspect that both of them also highlighted is whether those entrepreneurs are tourists or they are there for long haul. So because there is a wave and everyone wants to jump in. So have they actually done their own assessment and what is their skin in the game? and how perseverant will they be on this idea, because this is not going to be an easy ride. It's going to be a fun-filled ride, but not an easy one, adventurous and fun. So that is the first parameter. Second, I also see, because angel happens at quite an early stage. So are they open to experimentation and changes as the model requires? You'll also find that many successful startups started with X and finally developed Z.
Right.
So those dynamic feedback and working on that feedback while being very clear that what domain they want to persist is also important for the initial stage. So it's a very conflicting character to have in the founder. Perseverance is like, I have decided I'll do it, but while doing it, you are open to those changes which will make the model work. So Absolutely. This is a tricky aspect that needs to be assessed. So other than that, I think mostly everything is covered.
Sure. And I'll come to the next point, which you briefly touched upon, is like the portfolio. So how does an angel, or if we can touch upon the point that, does he just make one investment? Is there any magic number, or what is the average ticket size? How do we educate the audience on that? Because somebody is very new, he may get confused. So if we, the idea is to just educate them that this is a framework, if we can, bring out for a first time possible angel from a portfolio perspective, or what is that, way to look at it?
Okay. So first of all, I think then an angel should figure out their strengths and areas that they would want to, at least they have a good idea of their strengths and where they can assess that market itself, right? That's one. Second, I think an angel should, especially when they are starting off, to say that, this year I'm going to do, say, 50 lakhs or 1 crore. Just have that budget, right? And third, is there a way that you can co-invest along with somebody else? Therefore, your investment matters to the company. Rather than just taking that single bet, one check, 1 crore to a company until and unless you're so sure of it. Instead, is there a way that for that 1 crore, I can get 3 people or 4 people, right? That's another way to look at it. Largely for me, it's about co-investment. So I used to co-invest with HealthStart. I've played on health tech, edutech largely. And in health tech, I used to invest with HealthStart. Now they're not very operational. And that gave me, that portfolio itself was about 11.2x for my investment amount. And that's a really good return. So I kind of look at co-investment. And the ability, whether they are talking to someone else beyond us as an initial, and they're also talking to, say, a seed round investor or a next round A round investor. That's another thing that I kind of generally look at.
Sure. Perfect.
Yeah, so maybe before Praveen, you mentioned portfolio. I think one of the pieces you have to establish is that they have a portfolio thesis first, right? So, two things is, a lot of people, at least I have seen quite a few people come and ask me to say, somebody has asked me to invest, when you take a look at it, give your comments, right? Mm-hmm. And say, look, my comments are really not going to be any different than anybody else's who takes a cursory glance at a PPT, right? So I do the reverse. I ask them to say, do you have a thesis? Why would you want to do such a thing, right? At least if you don't have a thesis of where you want to invest, come up with a thesis of where you don't want to invest. Right? It's always good to form your thesis, because just like any other expectation, in that thesis, I recommend that they set aside money that they are not going to ask for at least in 5 to 7 years, because this is illiquid. You have to understand that you are in a relatively illiquid market as compared to any other investments that they have to go back. So set aside a portion, assume that you are locking it for 5 years. The second piece that I would recommend. The third piece that I would recommend is that be consistent in behavior and not work off like a stock tip that somebody comes and says. Discipline is also important in this space, just as you would do in a secondary market.
Correct. Sure, I think that's a good point, Ravinder, where you're helping the angel bring focus. And with that focus, it will also help him build expertise, because he himself will start reading more about it, gaining knowledge, and then he himself becomes he starts adding more value to that sector or that angel. So I think, yes, that's a good way of looking at how to approach a portfolio. Like how Sharda mentioned health tech and ed tech. So she's clear that she's been doing this. And then maybe then we incrementally add some other sectors. Valid points, valid. Praveen, anything from your side?
See, I think one, there is a step back observation that whoever is investing, angel funding is part of that portfolio investment. And this comes under a high risk and high return ratio. So again, it's advisable based on what age are you in, that percentage starts changing, or what financial freedom or degree of flexibility you have. Based on that, you decide. Generally, that percentage needs to be fixed, like fixed income asset, equity, whatever it is. So then it comes on top of equity based on the risk appetite. And if no one has done it, or if someone has not have any exposure in startup, it is advisable to have at least certain percentage now in this portfolio as well, because most of the wealth managers, etc., do not bring this as an investment opportunity. They bring at a later stage, Series B, Series C, but they don't bring it as an angel investment. And if you see, this new age has many such investment opportunities, like crypto is one of them, and you'll have strong divergent view whether it is an asset or not. People have made money out of it as well. So from money making point of view, I view startup having more foundation and enabler than crypto, but very open to crypto returns as well. So you take an exposure, because earlier people were conventional thinking, gold, real estate, etc., etc. What are the new investment opportunities, and what is the percentage that I lock into this? So one, this brings discipline. Now, second is a self-assessment, that what kind of person am I and where does I get comfort? So some people have this domain expertise lens. So they will like to do something which they know, or they at least believe that they can contribute. So then they should go specific into the area that they are expert in. However, as an objective person, I don't support it, because then you're too concentrated in your exposure, because your portfolio is in the same domain, your startup is in the same domain. So if that domain goes down, you have too concentrated a risk. But many people do it, and it's a decision based on the personality. Third aspect is identifying risk reward in this space as well. So some of the startups which generally become unicorn very fast are fundamentally heavy loss making, and that has a high risk, because if fund is not raised, then they collapse. And then there is probably a good return, but not such a high cash loss. So there you will have more predictability in future, but not those kind of return immediately. It might give you return. So what lens do you want to apply, or do you want to have a mix of both? So I've done both sides, and I have made money both sides. So generally, I try to keep a balance where there is a high growth, high burn story, and there is a very strong founding team who understands that cash burn cannot be infinite, and I have to take control if I am not able to raise fund. So generally, I take those kind of mixes and then try to stabilize the portfolio.
So great. No, I think that's a very, very valid points. In fact, I'll just make a comment that even on our portal, we are seeing a lot of even NRIs, and typically from the age of 25 to 40, where they've started investing very early at the age of 25. They have disposable income, but they have fixed it that yes, I have certain liabilities. Post my liabilities, I have this much residual. Rather than going before the expenditure, they are fixing it into their asset class. And startup is very much a area of interest for these, especially middle-aged and youngsters. So for the benefit of the audience, definitely it makes sense to do your risk profiling and start taking a call that X percentage of my net worth I can start investing in startups. And as we discussed, there is no fixed amount, or there is no fixed portfolio limit. So it's just about starting and taking the small steps initially.
So just an additional piece, Praveen very relevantly brought out things like crypto, things like what you will see. Now, on all of those, you can track your performance. Here, you should be willing to invest and not worry about tracking performance for a couple of years, right? I keep saying there's nothing you're going to, you can't call the founder every day and say, how's your KPI doing? You're just going to run them up the wall, right? So very, very clear that this should be a slightly different thinking than being somebody to watch the ticker price go up and the cryptocurrency exchange move
Right.
things out. There's nothing even close to it.
So on a lighter note, even the startup has to be careful that which angel is he picking. But if he picks this, angel is going to call him every day, then he is also going to have a headache.
Yeah. So
it's
absolutely.
very, very important on how the startups pick the angels also. Very crucial. It can't be, I mean, there are so many investors, so many mentors who want equity for free or equity in lieu of some advisory. So one of the things, the most valuable asset a startup would have to begin with is their equity, and they can't fritter it away. How they choose the early investors, how they choose the early angels is so crucial. Just to give you an example, especially when there are 2 or 3 rounds of investments that will happen in the company. And, as early angels, you would want to make space for the incoming investors, and you need to exit at a B round, for example, right? Though you know for a fact that you can make a larger there will be a larger up round, and there will be room for growth and make more money. Sometimes you just have to honor the founder's interest. So how they choose the early angels and their investors and who sits on their cap table, not just angels, any investor for that matter, how you choose is super critical.
Yes. In fact, today, even on, we have over 800 startups registered with us. So I get a lot of feedback that the startups are recognizing the fact that, it's not just the money. They would want other things like opening up of networks also, or, getting some sales scaling benefits. So they are getting choosy about that. But initially, maybe at the very early stage, it's the money that counts for the very early startups.
And then it hurts later.
Yeah, then it hurts. Okay, so my quick next question is how to handle the, which is on everybody's mind, is valuation. How does an angel play the valuation game, assuming he has no knowledge? So how does an angel talk about valuation? Praveen, I'll go with you this time first.
He's managed to get the last word in all the previous questions. So we should let Charna have the last word.
See, I think valuation, there is no science anymore. At least in this space, earlier there used to be at least some, I would say, guiding principles around how to be valued. However, I would suggest there are certain thumb rules by which it goes. One is, generally at a very initial stage, people tend to have a round ball number of around 1 million or so. And the reason is that the founders don't get diluted significantly in the first stage steps.
Right.
So since the business model is not proven, etc., no one should value at that number. But I'm just giving a rationale that if you don't value it and if you put in money, the founders get diluted in the second round. They don't have any skin in the game. So at least have that some sense and do the valuation. But then for angel, it becomes slightly risky. So the second model, which they try to make it work, is convertible CCPs, so that you get certain discount before the second round, and it's a timeline frozen contract. So you say within a year or 1.5 years, when you raise fund, I get 20 or 25% discount. So you get that kind of return in the initial phase.
Right.
So these two models generally work, but I have seen on paper and many pre-agreed VC or private equity startups. So they know this space, etc., that this needs to be worked on. So before the founder launches, everyone in the investor community is aligned. So you will see that they are raising 50 to 100 million within 2 to 3 months of launch, and they are being valued at 500 million. So you will see certain cases that as well. So it's not a single, I would say, explanation how it gets valued. Finally, it is the conviction and how collectively, along with the founder, the investors are working in, and how the valuation play works out. Generally, in most of the success stories, there is already a pre-conviction, if not an agreement, pre-conviction that in the second phase, certain investors are going to come and these valuations will be established.
Right.
So those are generally the most successful angel exits. But they are few and they are very limited in terms of angels to know about those opportunities.
Sure. Yeah, Ravi.
Yeah, I think he's covered most of it. The more and more we see either a convertible, safe note, or CCPS kind of a stuff. So basically, more and more, you will see some kind of a discounting to the next round, simply because you don't want to spend a lot of time going back and forth. Because technically, unless the next round happens, it doesn't matter what you start with, right? As a close, right? So, but as an angel, it'd be good for you to go back and think about what would be the next round multiple that you would want to see in what time frame, and use that as a point to say that, look, I want to be playing this role, or I want to be working on this particular structure, right? Because as an angel, on the other side, I don't see it as often. I used to see people who would ask for a very large stake, 40-50%, things like that, to say we'll come in and build the process. I don't see it anymore, and which is a good thing, because you are just killing the process, as Praveen said, working through. So you shouldn't even work through that.
Sure.
But there is a piece. If you are going as a syndicate, I would recommend that the syndicate has at least some piece, so that there is something for them to taste by the time they get to A or B. And if you don't have, as Praveen said, if you don't have a pre-structured or a pre-contracted mode of some kind, or a pre-established setup.
Sure. So for the benefit of the audience, I'll share our experience also. So, in 2019, we ourselves, wanted to raise our first seed round, and this classical example came that there is no valuation. So the way we approached other investors is that, we wanted to see who believes in our story. So if anybody who's understanding or believes in our story, we said that, this is come invest right now. And then we made a 1 year, 2 year forward projections, of course, with some discounting on the multiples. And we offered that upper cap, a cap and a floor to the investors, and gave a deep discount of say 33%. And typically that's where we shook hands, that the investors were interested in the business. And this is the via media we found out for getting, through the valuation issue. And it is, yes, as Praveen said, it's a time bound process where we had also taken 18 months, where we said if the next round doesn't happen, we will do our valuation once again and mutually agree on that round. And we will offer equity in that structure. So definitely these, and of course it's,
it also means that, it's always helpful to have a convertible instrument, not just the plain vanilla equity that goes as an issuance. A convertible instrument like a CCPS or a CCP, a compulsorily convertible preference shares or compulsorily convertible debentures, as the instrument of issuance for early angels. Therefore, all of this conversion ratios, either as a floor or as a cap, can be undertaken.
And my suggestion to all angels listening is that please get advice from experts, be it investment bankers, lawyers, because they bring in a lot of experience, and this can bring in a lot of value before you take that decision. So I think that's a definite takeaway I would like to offer to our audience. Sharda, coming to you, quickly we would like you to go run us through the legal requirements and also the tax implications for angels. So if you can help us with that round.
Sure. So typically it's a term sheet stage where there's a lot of discussion that happens with the angels. With an early angel and single person, perhaps you skip that step of having a term sheet. Second would be a due diligence. In an early stage, the diligence is on the founder himself and the market itself. But you'll be surprised that in early stage, there are so many non-compliances that come back to hurt. So it's helpful if the founders keep their slate pretty clean and neat. Therefore, it becomes easier for next rounds of investment, and it also shortens the time for money into the bank.
Yes.
The third phase is the definitive agreements, which is your shareholder share subscription agreements, and also the employment agreement of the founders. And one of the things that I would also like to tell the founders is it's good to have a founders agreement even before any investor comes into picture, because the business plan pivots, the founding team may change. So it would always be helpful to have a founders agreement, largely to kind of talk about what happens if one of the person were to leave, right? How do you treat their shares? So that's really helpful. More often than not, it is the founding team that many startups fail, and that's what happens in very, very early stage. So from that perspective, it is helpful to have a founders agreement. Then there would be the entire step from term sheet level, the discussion level, to money in the bank. There are about 63 steps, right? You need to get a valuation certificate, you need to get a private placement process in, there are ROC filings. If there is a non-resident investment, foreign investment, then there is an RBI filing. So put together, there are about 63 steps. And for a founder, it's good that he plans it much ahead, not at the last moment. I don't have salary to pay this month, and they tend to agree to anything that comes by from an investor as an ask. So it's good that they plan much ahead, because this process is going to take even in a very best case scenario, after to go meet an investor and evince an interest itself will take time, and after that it's a good 2 months, right? So it's good that the founders plan for it. So for a foreign investor, the additional step compared to an Indian investor is, there is a filing that is required with RBI, without which the money cannot be repatriated outside of India, and that's mandatory, and the investor will have to ensure that the company does it. Valuation is more of a function of what the investor and the startup look for, and then the valuation certificate kind of supports that. In terms of taxation, Ravi and I wrote up this angel tax letter for the Ministry of Finance sometime back, and what started off with Thai Bangalore chapter, and then it went on to so many other Thai chapters, including Silicon Valley, and then there was NASSCOM, CII, all becoming signatories to it. What this simply means is that an investment is not income. However, the taxation laws say if you cannot support that valuation, then it gets treated as income. Therefore, you as angel investors, make sure you advise the companies to be registered under the Startup India program. Therefore, it becomes helpful to overcome this issue. And it's always helpful that an Indian angel also invests with a foreign investment or with a fund like July Ventures, for example. Therefore, you have that benchmark that it's not an angel, an individual, but there is a VC fund where angel tax is exempt, or a non-resident investor where the angel tax is exempt. So that's helpful. So so there is no taxation at the time of investment. At the time of sale, it is capital gains tax. 24 months is what is relevant for an unlisted company, a private limited company. A short term is less than 24 months at 30% tax. There's of course indexation benefits under income tax, and long term, which is about 24 months, is 20% long-term capital gains tax. Not to be confused with listed entities, because there it is STT, which is different from unlisted. That is one of the things that we are asking for, saying that make it level field. Why are you making a difference between listed and unlisted? That's something I think, Ravi, you and I should again write.
Sure. So yeah, I always have this piece that we seem to treat the NRIs better than us because money is coming in. So the only additional piece to Sharda's statement is, while us resident Indians get taxed at 20 plus 3 or usually 23%, by the time you're done, NRIs get away with 10%.
So one thing for the benefit of the audience is that, Sharda, in startups who are registering in Startup India versus not, what are those benefits which a startup is getting, which would affect an angel?
Affect an angel. Okay.
Or an investor, basically, from that point.
For a startup, okay, let me answer this first part of your question. So for the startup, the benefits is that, the founding team can get equity incentive, can get ESOPs. That's a good benefit. Plus other, 3 years of tax benefits, and you can choose the 3 years out of the 10 years. And you get some benefits like your, IP filings, you get some benefits of, the fees is halved.
There is also an exemption on the merchant banking valuation, which we had seen that we did not need a merchant
bankers valuation, and it is just the registered valuer.
So that's another benefit we had seen.
Correct. And the bigger one is, you get away from the angel tax, the draconian angel tax.
I think that
there is a slight variation there, Sharda. It is not both. I don't think it's both on section 56. The KYC structure is still valid, so you have to do all of that piece. I think, the biggest thing is the merchant bankers valuation.
We had filled section 56, some form 2, and that's how we took benefit of that.
Correct. So it is applicable on section
merchant tax,
not on the angel side.
No, not
on the angel side. So on the angel side, whatever is needed as a KYC, whatever is needed for source of money, all of that still has to be complied with. There's nothing more changing that.
Sure. Okay, so that brings us to final couple of questions. That how do we look at exits? While all of you mentioned that there needs to be a lot of patience and it's a time-consuming process. But Ravi, how would you look at liquidation, or what are the exit options available for an angel?
So let me start by saying that it's actually looking much better than what it was. So I think that the whole ecosystem is getting much better. So you are actually seeing higher M&A exits. You are seeing secondary buys. You are seeing what I call as engineered buys, right? So in some ways, I think the market is only going to look better from an exit perspective. If you had been investing, let's say you had invested 12, 15 years ago, then you had to wait, and there's really nothing that was happening because the ecosystem was not mature enough to bring in and work through that process. So I think the good thing is that exits are getting easier, exits are getting quicker, and exits are getting more aligned to an aggregation or an assimilation process, which is always good, right? That's one bit. The second bit is that exits in some ways have to be engineered, or it doesn't happen by chance, right? So you need to kind of work through with the founder in some cases, with the other investors in a few other cases, where you go back and say, how do I go back and figure this out? Because in some ways, it's not just the exit, right? It's the timing of the exit, right? There have been cases where, I would have liked to stay, but because there's a big person coming in and you're trying to make space, you kind of give up and say, okay, that's fine for me to exit. Or you may want to, there may be somebody else who wants to get the angels, especially if it's a large cap table, then there is a piece where they want to clean up the cap table. So you as an angel have to figure out whether you want to continue sitting there.
That's a lesser evil. Challenge आता है कि exit नहीं हो रहा है.
So I think the good thing is that it's starting to see better pieces. But you need to always have which is the point that I think we started off in saying it's good to co-invest, right? Because it's not just you as an individual fighting this war, you have a team who are looking out and talking through that and making it happen.
So Praveen, what is your takeaway from for exits in your journey?
I think what Mr. Ravi also shared, most of the time it is the maturity of the ecosystem and the interest in that specific space. So for example, I made a recent exit in drone because drone is now in demand. There are a lot of policy changes, etc. And now VCs are entering into this space. But I had entered into this space as an angel. So it was 3-4 years back. So I got an exit just because of the timing. I did not have to really work for it. So that I think is generally how the process flows. However, there are situations when you have to trigger it because you see that the possibility of exit and the near future might be difficult. So you've tried to figure out within the network or through some other consultancy or intermediaries to seek for investors or an acquirer. So because they might have built something of value. So many times it can also happen that you might have to split it and sell it. So for example, the tech aspect can be sold as a solution. So then there is more like an involvement along with the founder, because it's more, as an investor, we are more like uncle, aunts, and grandparents. Founder is the parent. So they will not let the baby go easily. And we have to understand that and see how we are aligned to his or her thinking, and then see how our value can be captured, because angels have come not as a charity, but as a return. So those two aspects, one is it's a flow driven, you don't have to really work for it. And second is you have to trigger it along with the community of investors that are part of that startup. So both the models work. And in this space, you will see that a lot of startups who have got funding keep acquiring startups which are not funded. So that's a very good model. You will see, if you see the whole market, it keeps happening, where you get equity of a already valued company which gets acquired and you get a share swap. So rather than having a full loss, you have captured. And this is good for the ecosystem because then the angel investors keep investing. If you get losses in such startups, then many people will run away because initial few years they got a shock. So they will not have the patience to continue the long run. So broadly, this is how I look at it.
Sure. No, you're absolutely right. We're seeing a lot of M&A activity in the once it comes to the Series A, and with the war chest that the large unicorns have, we're seeing a lot of exits coming to the smaller startups, angel through this route, which I agree with Ravi would not be the case. Even not a decade, but even a few years ago, that was not the case. So definitely that's a takeaway for the angels, in our audience, that the exit spans are getting shorter and more opportunities are coming. In fact, large corps, we are discussing with a lot of large corp development teams. They are very, very keen to buy out startups in their space because they want to catch them young and at a good value, and more importantly, not let it go to the competitors. So that's another good space where startups are being bought out, and which again gives an exit to the angels.
Hormones, it's called cheaper R&D expense.
Yes, very true. Absolutely. Well said. Well said. So, okay, so that, brings us almost to the end. I have just a couple of quick questions if I can take in through. So any specific nuances for NRIs, while Sharda, you covered, but anything else any one of you would add for NRIs, because
I think they can typically invest into any company except retail. FDI in retail comes with some nuances, but other than that, they can invest into any sector at all. The thing about for NRIs, right? For example, for Ravi and I, we just go on HSR layout, we get all the signals and noises, but they might perhaps lose that signal and noise. That's something that they'll have to do. I think perhaps Merger Domo will sit well for them to get that kind of signaling also. That's something that they'll have. Those are the only two things that I could think of beyond the regulatory requirement.
Okay.
Yeah, so there's really no issue on repatriation as long as they have invested in and worked through. The startup has to do a few pieces like FIRC. They have to
RBI regulations.
Right. The RBI. So it's very, very important because a lot of people don't do that in terms of allocation, FIRC, and then it becomes a problem at the time of exit, right? So as long as those entry criteria is well cleared and well taken care of, you're fine.
Because yeah, very true. Because we feel that with the startup ecosystem, we need to channelize the NRI money back home, and the easier it is, it's better for the ecosystem. So
it's pretty easy, Hormaz, for NRIs investing into India. Pretty easy.
Which are my experience with us has been that it's a mindset issue. Dur hai, kuch karna hai. I'm just investing in my FD. On the other hand, there are these young boys which I said they're extremely gungo, or sitting in the Silicon Valley and you're like, yes, we want to invest into startups. So it's a bit of a mixed bag, but it's a journey we have to take up. But the easier it is, it's faster for them. So my final question to all of you is on governance. From an angel perspective, what should he look at that it's the company can come out with a very appealing PPT, but what's going behind the scenes is something which an angel should try to dig before investing. So any thoughts on how to dig those things out, Sharda?
At an early stage, you're very, very close with the founder, and you can figure out the integrity level, the intention level a little more easily. And it is a very small check. There isn't much that they can do. But having said that, let me share one of my bad experience. I've had fabulous experiences, 30 plus companies that I've invested in. It's just one company that I had a very bad experience. So this was a guy who wanted to do his further studies, comes and takes an investment. And in about 2 months, he just goes incommunicado, and he uses this money for his college education. And then we had to swiftly move in and go meet the bankers, freeze it. And we had to do certain things. Of course, we lost a bit of money. Sometimes hindsight, what is it that we could have done to get this checkpoint, right? Of the intention of the founder was very, very difficult. And it's a very small world. LinkedIn, etc. You can still get them, but some bad apples. I think what we could have done better. I really don't know. In terms of it's at the later point in time that you can ask for an MIS and other kind of reports from the founders, but at an early stage, a bit difficult. But make sure that the founder also takes some salary. Therefore, he doesn't dip into the company's coffers.
Yeah. My one of my co-founders always used to say कि kitchen chalana hai, तो kitchen तो सबको चलाना है. So every founder should take a salary, because we don't want to demotivate or that incentive has to be there. So absolutely. Praveen, anything from your side?
So I think what Sharda ji shared, in the initial stage when we are funding during angel or seed, the companies or corporators are not ready for stringent compliances. Those processes are not built. And in fact, the one experience that was shared was more like a fraud. It was not a governance issue. It was a fraud. So fraud and process mismanagement in terms of revenue leakages or taking money are two different aspects that I'll have a lens on. And at our stage, it is generally you interact with founders so much that and then you help them if they don't come with that background to put those compliances. Because many a times I've been part of those founder team as well and investors aspect as well. And many a times I have seen the founders, not all the time, but when founders did not have any wrong intention, but as per corporate governance and the high level of ethical values, it was not allowed. But founders tend to get things work done. So they will find a jugaad. So there was one case where it was said related party, someone has given to a relative. And incidentally, I was aware of the whole situation where the market prices were not being matched, and as a favor it was given so that it could be done under a discount. And that aspect became a big corporate governance issue.
Right.
I also know of a case where there was a real, the founders did really misuse the fund. So I'm taking that what we capture might not be the full essence. So you'll have to guide and mentor, because many of them come from a pure technical background. They think to do what is right right, rather than what is compliant.
Right.
So that aspect needs to be taught, and they need to be encouraged, so that it gets established. Even from a founder's perspective, when the large VC and PE comes, they push the founders to get things done.
Absolutely.
But if anything comes up, then the whole blame goes to the founder. Because of the speed, many of those compliances are tossed.
Right.
So I think as an investor, we should also be aware and coach and guide, because as the companies get listed, then it becomes slightly more demanding from a statutory point of view. So if you are not groomed, or that culture is not crept in, then it gets diluted. Otherwise, what Sardaji had shared, the founders really well. It's not that we are off distance. We know them, and then we take a call.
Perfect. Yes, Ravi, any?
Yeah, so just two very quick points. I think it's investing in time before you invest the money, right? I kind of capitalize, because you have to go spend time. You have to invest that time before you decide to put the money in. And it's like any other HR recruitment process, right? You are trying to see them in different conditions. You're trying to walk that through. You maybe do it in a coffee shop, maybe do it in your office, maybe go to sit in their office. I've known investors who are very close to their investee, but they've never visited them. I can't understand that. You're saying, look, you have to get off your high horse if you're getting serious about this. Spend some time. So I think investment is time is something that I would recommend. One other piece that I would recommend is, as an investor, that there are some downstream impact that are very important, that is not understood by a founder, right? So the example that I mentioned earlier is, if you've got foreign investment, you have to file an FIRC. If you have not done it, it's a downstream major impact, right? It's up to you to go back and, as investors, go in and say, look, there are a few things that you can do, Jigad, but there are a few things that you should focus on. And that's the advice that I think you should be out working through and spending time.
Superb. I think very true. In fact, in our own journey today, having over 18 investors, I think every investor has spent more than 3 to 4 meetings, and I have flown down to every city where they are, convinced them totally. And, I think that's the maturity of the investor also comes out over there, before he cuts the check. And all of them have always seen that what additional value can they add in terms of, apart from the money they're bringing. So yeah, that's a good takeaway. So I'll bring the session to an end over here, and I'll thank the panelists, the audience, and our partners, TAI, Bangalore, and Mighty Startup Hub. And I hope everybody took away some key learnings from today's session. And we at Mojodomo are constantly helping startups and investors come together through our algo-based platform, where investors are showcased curated investment opportunities based on their investment thesis. So we would love to have all of you come aboard on our platform and start your investment journey at a click of a button. So I thank you once again, and over to you, Vinay.
Yeah, very insightful session. Thank you everyone for your time. We will be sharing more about our upcoming activities. In fact, we're going to do one-to-one matchmaking, hoping that all of you will get to know each other really well around our flagship TAI conference called the Matrix 2022. And we'll keep you posted on that. Thank you, everyone. Have a great day.
Thank you.
Thank you.
Thank you.